Namaskar. Let us discuss about international capital budgeting. As you read in corporate finance, capital budgeting, how to take decision about long term investment, which cash flows are spread over a long period and initial investment will be huge in nature. So, initially we are spending lots of money and the returns are coming over the periods. Without evaluating the project, you cannot go for a long term investment or in the form of capital budgeting. Hence, generally in corporate finance, project finance, a part is project finance or capital budgeting, you discuss about different methodology so as to articulate the evaluation procedures of different forms of capital budgeting. When we discuss about domestic capital budgeting, the fluctuation of exchange rate is not the part of that. Similarly, the international risks in the form of political risks, in the form of benefits also like subsidies, royalty payments, you are in the form of differential taxation, these are not applicable in case of domestic capital budgeting. When you mention the word capital budgeting, we should understand that here we are evaluating project which involve huge investment in 3-4 years and which returns are spread over a long period of time. So, when returns are spread long period of time or many years, it has own risks, and when the returns are in the form of foreign exchange, it will have another risk also. So, we have to evaluate this risks of international project finance in the capital budgeting decision process. Let us define what is capital budgeting, what are the difficulties are there in international capital budgeting, which are the methodology available for international capital budgeting. Then we will be discussing about the foreign exchange problem in international capital budgeting, and we will be evaluating the entire process of evaluation with a practical example. Let us move to define what is capital budgeting. When I mention international capital budgeting, first we have to go to the discuss about domestic capital budgeting, then we will define what is international capital budgeting. As we know, capital budgeting evaluates the investment decision related to assets. Here assets mean a machinery, a technology, a long term investment proposal which create some kind of physical asset, some kind of capital which provide return to us. The term capital in capital budgeting refer to the investment of resources in assets, while the budgeting refers to the analysis and assessment of capital cash flow and outflow related to proposed capital investment over a specified period of time. When he mentions capital in capital budgeting is a long term assets, a long term investment, and budgeting means the cash inflow and cash outflow. Cash outflow is the initial plan investment, and cash outflow are the cash returns. Returns are available over a period of time. So, capital budgeting or capital investment has two aspects. One aspect is what are the initial investment, and second aspect that the cash inflow which are coming in the long run. The objective of the capital budgeting, if you analyze, to determine because we have a number of proposal, because a country generally or a company generally have less capital, but they have alternative investment proposal. The capital budgeting try to evaluate the alternative investment proposal and try to find which proposal is good for the company. So, capital budgeting is nothing but selection of alternative investment proposal, the proposal which increase the value of the company, the proposal which gives good return for the company, the proposal which provide or improve the stakeholders money. The capital budgeting primarily the evaluation process of alternative investment proposal. Here capital is referred to a long term assets and budgeting is the assessment of cash flow and cash outflow. When you internationalize this capital budgeting, same meaning will be that in the international level we have investment proposal and international level the cash flow, cash inflow and outflow will be there. You have to evaluate the cash inflow, cash outflow and alternative investment proposal which are spread over different country. However, in international capital budgeting there are some issues are there, the issues related to exchange rate fluctuations, issues related to capital market segmentation, capital market integration, issue related to arrangement of investment, issue related to international taxation, issue related to country taxation, issue related to subsidy, royalty payment, political risks, many other things are there in international level of discussion for capital budgeting side. So, we have to address all these issue and try to find which are the alternative investment proposal best for a company. If the company face a number of proposal and they want to select one proposal for investment side. The international capital budgeting, though it is the process is same, but the implication is very difficult. The implications of taxation, implication of international financing, implication of capital market integration, implication of country risks, these are the some kind of issues generally affect in international capital budgeting process. So, when we discuss about capital budgeting, we should also understand which are the methods are available or process are available for evaluation of alternative process of capital budgeting. Generally at present or many companies are using the net present value methods. A net present value methods nothing but the initial investment are present form and the return from the initial investments are future oriented. You have to bring the future cash flow to its present value in the form by discounting it with the proper discounting factor and compare the present value of initial investment and the present value of future cash flow and try to find what is the net present value. The net present value is positive, then generally you go for the investment. If negative, we do not go for the investment. Here we are comparing the present value of present investment with the future cash flow by bringing the future cash flow to its present value through a discounting factor. Net present value methods generally all companies are using for evaluating the alternative investment proposal for capital budgeting side. The investment decisions of a firm are generally known as capital budgeting or capital expenditure decision. Investment decision, expansion, maybe because there are many kind of investment decisions are there. It may be expansion, it may be acquisition of new resources, it may be modernization, it may be in the form of what is called investment or replacement of old machinery. So, investment decision not always related to a new investment proposal. It may be a old investment proposal, old machineries are there, you want to replace it. It may happen the existing machinery you are expanding it. It may happen acquisition of new machinery. It may happen that we want to modernize the existing facility. So, investment proposals are different kinds. So, we have for different investment proposal generally one method or generally we call it net present value is applicable. There are many other methods are there like the internal rate of return, it may be what is called the payback period, discounted payback period, simple payback period, real options methodology. There are also other methodologies are useful for evaluation of capital budgeting side. But in our present example we will be discussing about the net present value methods, because that these methods are applicable almost all investment proposal. Here you have to understand that in case of net present value approach, the funds are invested in the long term asset, so as to create cash flow over a long period, because initial investment will be very huge, but we are getting the returns from the investment in the long period over a period of time. The future benefit will occur to the firm over a series of years, number of years will be there, and a bullet payment type of returns will come from the investment proposal. And this investment proposal huge investment initial period, and cash flow or return from the proposal investment proposal long period. So, the spread over 10-15 years of cash flow, you have to bring it to present value and compare with the present investment, and the net part, the present investment and the present value of future cash flow, both are there is a net surplus available, then you will go for the investment. That net surplus amount generally called net present value. The net present value, what you are supposed to do in net present value? You have to estimate the cash flow, future cash flow you have to estimate. Then the future cash flow need to be discounted, because these are future cash flow, you have to bring it to present value. So, that this future cash flow need to be discounted, and you have to find out what is the proper discounting rate. Then application of decision rule, if the NPV is positive or NPV is negative or NPV is 0, what decision we have to take from there, the decision methodology you have to use here. So, any investment should increase the shareholder value. Our bottom line is here, our objective of net present value method is that any kind of future expansion, future modernization or future replacement of old machinery or any kind of new investment should increase the shareholders value, the owner's value, you have to increase it. It should recognize the fact that bigger the cash flow, we have to prefer the investment proposal. So, the cash flow should be bigger in nature, the cash flow should immediately come. If the same cash flows are coming from two proposals, same cash flows are coming, but one proposal give cash flow in a later time period, then another proposal, then you have to accept the first one. So, here the NPV should be more and it should increase the shareholders value, then we are supposed to get back our initial investment very easily, it should be profitable project, then you are going for the calculation estimation of the NPV method. What are the criteria are available for NPV side? Here we have to estimate the cash flow, that means you have to forecast the cash flow. Then you have to future cash flow need to be discounted to bring it to present value. Then here you have to discount, you have to estimate or you have to decide about the discounting factor. So, which discounting factor you have to use? It is our judgmental decision. So, discounting factor also affect the NPV method. So, then if the discounted cash flow more than the present in outflow of investment, then you have to accept the proposal, that NPV usually positive, you have to accept the proposal. If it is less, then you have to reject the proposal. So, what are the difficulties are there? Difficulty of forecasting the future cash flow. Difficulties here selecting the discounting rate. So, on this two entire NPV method based upon. So, what is the NPV formula here? If you see the formula NPV here C, here you have to understand the NPV here C1, C2, C3, these are the cash flow and these are coming different time period. We are using here NPV here, we are using NPV here C1 by 1 plus k to the power 1, C2 by 1 plus k to the power 2, like this it will go Cn 1 plus k to the power n minus C naught. C naught is the initial cash outflow. C naught, you have to understand what are the things we have written here. C naught is the plan investment. how much you are investing at 0 time period, plan investment. At 0 time period, what is the investment, what is the outflow of cash, and here C1, C2 like C1, Cn, these are the cash flow occurring at first year, second year, third year up to n year, and k is here discount factor, the discount factor k is here discount factor. You are discounting the future cash flow to bring it to the present value and comparing the with the present value. If discounted cash flow, this is the DCF, discounted cash flow, this is the initial cash flow. If there is surplus available, then our NPV will be 1 I1 to n C I by 1 plus k to the power I minus C naught. If it is positive, more than 0, you are accepting NPV will be positive and you are accepting the proposal. So, what is the NPV here? NPV should be positive, NPV can be negative, NPV can be 0. These three situations may arise, and here each situation you have to take a decision. This situation definitely we have to accept the proposal, this situation we have definitely we have to reject the proposal, and this situation when NPV is 0 we are indifferent, we do not know what supposed to do. So, rarely this kind of situation will arrive, either we have a positive or negative situation and you have to take a decision on that. Then question whether NPV is good or bad. NPV criterion is good or bad, you have to understand that. So, here with positive NPV we are accepting the proposal, negative NPV we are rejecting the proposal, and higher the NPV, higher that proposal will be good for us. So, suppose you have a number of mutually exclusive project, means we have a one investment to choose, but mutually many projects are there which are mutually exclusive. So, we have to choose all NPV, all projects give positive NPV to us. Then how to take a decision? The project which give highest NPV, we should select the project. So, but NPV, what kind of things the NPV takes into account? NPV is good because it takes into account the time value of money. Why? We are discounting the future cash flow, bringing it to present value. So, we are comparing everything at present. So, we take care of the present time value of money. Then second most important thing is that it measures a true profitability. Why it is true profitability? How much you are investing, how much you are getting. If it is positive, we are accepting. The profitability take care here. Then third most important thing, shareholders value maximize, because here the end of the day, after all expenditure, what is coming to us, that is the value of the shareholders or the promoters money. So, shareholders value also take into account. But NPV, many things in NPV do not take into account. These are called taxation, subsidy, royalty payment, many other things are there, it never take into account. And a more important thing here, NPV here, you have to find a discount rate. The discount rate very difficult to find, because discount rate depends upon what is the opportunity cost available in the economy, because we are choosing proposal A against proposal B, then what is the opportunity cost? We do not know the opportunity cost. Opportunity cost nothing but I don't want to invest, I will keep the money in the bank deposit. If I am getting a good return, then I have to, why I should go for the project. By investing in project, I am accepting risks. I may get, I may not get return. So, by a risk free interest rate is the opportunity cost for me. However, if the project cash flows are spread over many years, more than 5 years, 7 years, 10 years, we do not know, the opportunity cost may not remain constant. We are accepting that opportunity cost remain constant, opportunity cost never remain constant, because there is change in the value of money, the interest rate changing, inflation also changing. So, opportunity cost may not remain constant over a long period of time. You have to go for a variable opportunity cost. If you include a variable opportunity cost, you have to redesign the NPV again. So, It is generally NPV long time period. If a project, the lifespan of the project is more than 10-15 years, you cannot continue with the project one NPV, one discounting factor. You have to use multiple discounting factor in period of time. We have to go for a scenario analysis, because each scenario will change the discount rate and try to find a scenario type of NPV. Similarly, these are the domestic side. We have not included the foreign exchange here. So far, whatever you discuss, a discussion on NPV domestic market, a domestic level. We have not included the foreign exchange or international market or international capital budgeting side. Let us move to the exchange rate side and capital cost. So, when you we have discussed earlier that a company can have international project, because a domestic company like US company can invest in other than US, like in India, in China, in some other country. Similarly, Indian company can also invest in Bangladesh, Bhutan, US, any other country. So, here domestic market is not involved, the market is here foreign market. We are not receiving the cash flow in domestic currency, we are receiving cash flow in foreign currency. Suppose there is taxations are available, you have to pay tax where the project located. Similarly, when they bring the money to India, you have to pay tax in India also. Similarly, you may get a subsidy in a project where subsidy may be available by the company, by the country where the project is located. Here, when they bring the money return to the country, to domestic country, country may give us a, since you are bringing foreign exchange, you may get some royalty. So, many things are involved in case of internationalization of capital budgeting. So, the NPV using the home currency cost capital may not be available to us. You have to analyze the cost of capital or the initial investment or the discount factor in the international aspect. So, when international systems are available, here domestic market not going to help us in deciding the decision about international capital budgeting side. You have to understand that we are investing in foreign country and we are accepting the foreign currency risks also. We are investing in foreign country, we are accepting the foreign country risks also, the political risk, the market risk of the country, you are accepting it. So, similarly, we are accepting the rules regulation, the geographical rules regulation, countries rules regulation, country taxation principle, subsidy principle, country depreciation side, everything we are accepting where the project is located. So, all these factors you have to take into account while taking a decision on the internationalization of cost of in capital budgeting. So, here you have to understand that the two things are many things are involved in this process of internationalization of capital budgeting. First, NPV, you can see the graph here, NPV is NPV here, NPV here, the NPV is coming by a discounting factor. So, investment, it may be incremental, it may be expectation of certainty, make investment, what are the capital, your foreign exchange coming to us in the form of cash flow, then it may not be, it may involve some kind of risk. It may not come in the form of what we are projecting, because we are forecasting the cash flow, while forecasting error will be there. So, that kind of expectation we are putting here, the expectation may not be realized. So, all kind of errors are there in case of cash flow also. So, we are forecasting the cash flow on the basis of some growth indicators. The growth indicator may not be valid in the long run. Similarly, whatever after the investment over, we are supposed to get some terminal values. The terminal values may not be available to us. Similarly, when you go for the sourcing the capital, because our cost of capital, we are borrowing money from the market and investing in new plan expenditure. So, the cost of capital may not remain constant, cost of capital may also change, our cost of borrowing also change. So, everything change in the international scenario, while accepting a long term investment in long term investment or long term investment proposal, where investing initially is not going to solve our NPV, the domestic side of NPV. The NPV of domestic market you have to internationalize by factoring all kind of risks and benefits in the international capital budgeting side. So, what are the system procedures available here? So, before going to that NPV criteria of international factor internationalization of capital budgeting, we have to understand three more important factors. First is here in international capital budgeting side, international capital budgeting side, what are the risks are there and what are the benefits are there. You have to articulate the risks and benefit together. Risks is here, first and foremost risk is here capital, what is called the political risks. Political, where you are investing, which country you are investing, that country political risks we are accepting. Political risks means instability in the country. The instability affects the growth prospect, the growth affects the cash flow of the company, the cash flow, because all these parts are the part of our investment proposal. So, political risks you have to take into account. Saying we are accepting, we are receiving this, we are receiving that cash flow in foreign currency. So, currency volatility we are accepting, currency volatility we are accepting. Similarly, we are also accepting what is called the conversion of currency, because the company may be domestic company is investing in abroad. So, we have to convert the foreign currency into domestic currency. So, currency risks also we are accepting, we are observing. Then also we are observing what is called the country where your investment proposal is there, their country what is called taxation we are accepting, their country depreciation of capital expenditure, that also we are accepting. We are accepting the country where the proposal, where the plant machinery will be there, the production will be there, that country enter market demand factor we are accepting. Market demand factor we are accepting. So, again we are also accepting, if you understand there, if you understand there, these are the risks of the international capital budgeting. Similarly, but what are the benefits we are getting? The benefits are we are getting a large market. We are investing in other country, the large market, we are accepting a large market. It may happen the country may give us some kind of subsidy, the country may welcome foreign capital by provide some kind of subsidy. It may happen that country may have a lower taxation compared to our domestic market, lower taxation. It may happen the country also provides some kind of royalty in the form of bringing the money, investing further in the country, or the taking away the benefit or taking away the profit out of the country. The royalty payments may be available. It may be also possibilities are there, the company also bringing some kind of technology export will be there. Technology export side also we can get some kind of royalty payment. Since we are accepting the market of the country where our project will be located, their cost of labor, cost of inputs may be lower cost of input, lower input cost in the form of raw material, some other benefit in the form of labor cost, lower labor cost will be available. These are the benefits available to us, these are the risks available to us in international capital budgeting. Everything you have to factor while taking a decision about NPV. NPV is our criteria of evaluation. So, while accepting this risks and benefit, you have to recalculate or re-estimate the NPV in international capital budgeting side. This is not so easy, because many things are there, it is not possible for us to quantify it. Quantification side is very difficult, like political risks, how to quantify it. Similarly, risks of what is called market demand, you have to forecast it. Similarly, what kind of large market available to us, we are accepting how to quantify it. These are the some expectations are there, some quantification problems are there in capital budgeting. Everything you cannot do, cannot factor while evaluating the long term investment proposal of international long term investment proposal. So, we have to go for some kind of calculation, some kind of estimation process, and by factoring which are the possibilities are there for quantification, some kind of value judgment which are not possible to quantify. So, both subjective and objective methods are used in for capital budgeting side while evaluating international level of capital budgeting. So, before going to the capital budgeting, let us discuss the one problem. That problems help us in analyzing how the capital budgeting will be capital budgeting criteria are taken into consideration in international level. So, let us see the examples here. Here when a US MNC multinational company is considering a European opportunity, because a multinational company located in US, there is a opportunity in European market, it is evaluating the opportunity of European market. The European project has initial investment of euro 750 million. So, the US company need to invest 750 million euro in European country. It provides 35% return each year in its 7 years lifetime. The proposal has a 7 years lifetime. Each year the company will be getting a cash flow of 35% in the form return of initial investment. The proposal will be 7 years lifetime. The project would get a royalty payment of 10.5% of return each year, which is non taxable. So, whatever the cash flow generate, 10.5% will be a royalty payment the company will be getting. On 10.5 there will be no tax, on royalty there is no tax. Then with a tax rate of 35% and straight line depreciation, evaluate the project acceptance. The tax rate of the company, corporate tax rate is 35%, and the country has a straight line depreciation. So, using this you have to evaluate the capital acceptance or rejection of the capital budgeting, the investment proposal. The project would be having operating cost 18% of return. The operating cost of the project is 18% of return. Every year there will be 18% of return in the form of operating cost. Inflation in US is 4% and that of Eurozone is 2%, because inflation affects the currency conversion. So, there will be 4% in US, 2% in Eurozone. Then US inflation is more, US dollar will depreciate. Eurozone inflation is less. So, as compared to US inflation is more. So, US currency will depreciate. The country spot rate is 1 euro will be is $1.28. So, spot rate of the market 1 euro is $1.28. Expected opportunity cost for the MNC in dollar term is 15%. Evaluate the project. So, the opportunity cost or the discount factor is 15% in dollar terms, not in euro term. Dollar term you have to evaluate the project. So, here it is a very big question. The question here, the project is in Eurozone and who is investing? In US company is investing. So, you have to evaluate everything the NPV in US dollar term. So, but we do not have returns, opportunity cost, return, depreciation, your taxation, everything in euro currency, but our NPV end of the day we have to evaluate in US dollar. And there is a conversion rate. The conversion rate will be changed because the time period is more than nearly 7 years. There is inflation in US is more, Eurozone inflation is less. So, currency in US dollar may depreciate further. So, we have to evaluate all these things and try to find international level of capital budgeting, whether you have to accept the Eurozone proposal in dollar terms or not. How to do it? You have to understand the step by step here. So, each year their cash flow, the cash flow will be in each year. The how to evaluate the cash flow? the cash flow is each year 35% of the investment. We have a initial investment in euro dollar, euro currency. So, initial investment is euro 750 million. Each year we are accepting, each year the proposal is the project lifetime is 7 years. Project lifetime is 7 years. So, and each year the return is, each year return is 35% of initial investment. Each year the return is 35% of the initial investment. So, every year we are getting 750 into 35% of 750, every year the returns will come to us. Then each year the opportunity cost is available, the operating cost each year is 18% of initial investment. Initial investment is, that is 750 million euro, every year 715 million of euro. Then we have royalty payment, every year the company get a royalty payment. The royalty payment is non taxable. So, royalty payment is 10.5% of 10.5% of return. Each year getting return of 35% of 750. So, 10.5% of return of each year the royalty payment. Then depreciation is straight line depreciation, as you read in corporate finance or accounting. Straight line depreciation means the over the life period of the project you have to get back the project investment money. So, here 7 years project, each 750 million by 7 years, that will be each year depreciation, 750 by 7, that will be each year depreciation. Then the net cash flow will be that net cash flow, then we have to estimate the net cash flow. Net cash flow is how much? Net cash flow is nothing but return minus operating cost minus royalty payment minus depreciation. This is our return. This is net cash flow. On this tax will be there, tax rate is 35%. So, on this tax will be there, after this tax on net cash flow, tax on net cash flow, that is 35%. We got 35% net cash flow, the 35%. After that we will get what is called net profit. Net profit will be net cash flow minus tax. After getting net profit, you have to calculate the actual cash flow. Actual cash flow will be net profit plus royalties company is enjoying, you have to add the royalty. Then depreciation will be there in the system, you have to add the depreciation. That will be your cash flow for the company, each year will come. After getting the cash flow, this cash flow in euro term, we have to convert the cash flow into dollar term. So, we know that how to convert it. Conversion will be conversion in dollar term will be H1, what is called conversion rate, H1 will be 1 plus US inflation divided by 1 plus euro inflation into the conversion rate. The conversion rate is 1.1 euro is $1.2. So, into conversion rate. So, you will get the to the power, because 1 you are considering 1 to the power 1, it will be 2, it will be 2, like that you have to calculate the conversion rate here. This is inflation inflation lead to depreciation of US currency, because US inflation is more than eurozone. So, you have to do this, so that after this we will get what is called cash flow in dollar term each country each year. After that you have to calculate DCF, discounted cash flow. Discounted cash flow will be cash flow in dollar divided by 1 plus discount factor is 15%. So, I will be 1 to 7 years. This will give you the discounted cash flow. The summation, this discounted cash flow you have to sum it up and minus the initial investment. Initial investment is 750 euro, 750 million euro into 1 plus US inflation divided by 1 plus euro inflation, because this 750 need to be converted into Indian your dollar term. So, 750 million. So, 750 million in what is you have to convert into euro, convert into US dollar. So, euro inflation into 1.28, that will be calculation process. If it is positive, then our NPV will be positive. NPV is positive, you have to accept the project, if negative you have to reject the project. So, these are the steps involved in calculation of this problem. Let us move and estimate the entire exercise in a Excel sheet. I have done it here, you can see here. So, here I have what I have done, written is what, 35% in every year, 35% of what, everything is now in euro term. Our initial investment in 0 year, investment in 750 million, this is 750 million every year, each in initial year of 0 year. After 0 year, first year up to 7th year, we will be accepting what is called 35% return of 750. So, you can see that here 35% of 750 every year, 35% every year till the end, till the 7th year. So, what is 35% 750 is 262.5 million. Since 750 is million, so 262.5 million every year we are accepting a cash flows 262.55 every year, and this is then our operating cost in 18% of the cash flow. The cash flow of 262, 18% of this is 47.25 every year the operating cost is coming to us. Then royalty payment 10.5% of the 752 and the year cash flow. The cash flow is 362, 10% of every year, that every year 10%, the royalty payment is here every year 27.5556, every year royalty payment will be there, that I have mentioned here. Then after that depreciation will be there. Depreciation I told you, the depreciation is 7th year you have to recover the 750 million, 7th year you have to recover the 750 million. So, 750 million by 7 every year 107.14 every year depreciation, and net cash flow is nothing but cash flow 262 minus operating cost 47.25 minus royalty payment 27.56 minus depreciation, that will be our net cash flow 80.54. What is how we got it? Because first year our cash flow is 262.2, our operating cost OPT cost is operating cost is 47.25, 47.25, royalty payment, royalty RP I am writing, royalty payment is 27.56 and our depreciation is 107.14, 107.14. These are expenditure. These expenditure, these three are expenditure, this will be minus from here. So, that will give you net cash flow. So, if you add all these three minus from 262.2, 262.5 we will get the 80.54 are the net cash flow. 80.854 is the net cash flow, and on this 35% tax will be there. Tax on this 35% tax, 35% is a corporate tax. So, that will be 35% of 80.54 is 28.19 and 28.19 is a tax. If you minus that tax from NCF, we will get what is called net profit. The net profit is our net profit is 80.54 minus 28.19, this will be something around 52.35 will be the cash flow net profit for each year. You can see that here every year we are receiving this 50 net profit of 52.35 because everything remains constant. So, every year we are receiving the net profit of 52.35. Then how we got the total cash flow? The net profit, because here royalty payment, depreciation, these are the two component company is getting. There is no outflow, there is this will be there with the company. So, you have to add in the net profit royalty 27.56 and depreciation 107.14, we will get 187.506 as the total cash flow in euro every year. So, every year getting the euro component of 187.06. So, that is a cash flow. Now, we come to the second table. Here in 0 year 750 euro is outflow, 750 euro is outflow minus sign, and what you are getting? Every year you are getting 187 point here cash flow every year. This cash flow is coming over here 187.06 as the cash flow up to 7th year. But FX conversion rate, I told you how to calculate conversion rate. Conversion rate S1 is equal to 1 plus US inflation 4% divided by euro inflation 2% into 1.28 is the conversion. 1 euro is $1.28. So, S1 will be in dollar term. S1 will be in dollar term. If you calculate, you will get every year this in 0 year this power will be 0. So, it will be 1.28. In first year 1.1 plus 4% divided by 1 plus 2% to the power 1 into 1.28. This will be how much? This will be 1.31. Then third year, second year like that you have to go. Ith year it will be 1.4 1 plus 2% to the power I into 1 into 1.28, that will give you I change 1, 2, 3 will get the conversion rate. The conversion rate I have calculated here, you can see that conversion rate every year, and if you multiply the conversion rate with the million euro, they will get cash flow in US dollar term. First year the 0 year there will be 960 cash outflow is there minus sign, and every year you multiply 187.06 with 1.31 will get this one. Like that 7th year 187.06 multiply 1.47 you will get this 274.3. This is the cash flow in dollar, in million dollar it come, and after getting the cash flow in million dollar you have to convert this into, these are future cash flow, you have to bring it to present value by discounting them with a discount factor of 15%, that is opportunity cost of capital for the company. So, you have to discount, this is 0 year there is no discounting, first year the discounting factor when you discount it first year what will be that? First cash flow 212, that 244.13 first year cash flow 1 plus 15% to the power 1. This will be coming out much 212.129 like that. Every year discounted and bring it to the present value and sum it up. 960 will minus sign, it will go out from the system, other thing will remain with the system. Total NPV, that NPV will be 105.94 million US dollar, US dollar in million. So, that is a positive NPV. So, we have to accept the project. Positive NPV of 105.94, we are accepting the what is called the investment proposal of US MNC in Eurozone area. So, here the calculation takes place like that. Here we have adjusted the royalty payment and depreciation. You can also adjust some other example, you can adjust the subsidy, you can adjust lax borrowing cost, you can adjust what is called lax taxation, like that. You can also adjust the political risk in the form of extra discount rate. Suppose the political risk is more in Eurozone, you can extra 2% extra discount rate, in place of 15% you can use 17%, because country specific analysis are available, and each country what is the risk of investment, that also available nowadays to country risk calculation process, that can be factor in discounting as a discount factor in estimating the NPV. So, the references are here, you can see the references International Financial Management, you can UN Resnick 2004, you can go through that. You can go to the Multinational Financial Management by Jeff and Madura. You can also go through Multinational Financial Management by Alan Shapiro and see that how the international capital budgeting dealt with there. Some questions I put here, my model question here, you can go through the model question, discuss the nature of international capital budgeting and what are the adjustments required to carry out for converting domestic capital budgeting into international capital budgeting. You see, you have to mention here what is domestic capital budgeting, you have to mention here what is international capital budgeting, and what are the adjustment of royalty, adjustment of taxation, adjustment of subsidy, adjustment of country risks, adjustment of political risks, adjustment of differential taxation, adjustment of depreciation, like adjustment of what is called your less labor input. So, all this adjustment you have to do in domestic capital budgeting side to convert into international capital budgeting. The major adjustment here, what is the currency fluctuation side, that also part of the adjustment process. Second question, here inflation in US 6.5, in Eurozone is 3.75. The current spot rate is 1 euro is 1.26 US dollar. Expected opportunity cost of in MNC in dollar term is 12%. Evaluate the project if the after tax cash flow are given to us. Here after tax cash flow in 0 year, first year, second year, third year given to you, and the euro conversion rate is given to you. 1 euro is 1.26, that is spot rate, and but inflation in US is 6.5, inflation in Eurozone is 3.75. So, the differential inflation lead to depreciation of euro dollar, and there will be change in depreciation rate. So, how to do it? In first year, in cash flow, it is 0 year I put here, and cash flow in euro currency. So, 0 year there will be minus cash flow 1,550, and first year, second year, third year. First year is 450, second year is 675, third year is 825. These are the cash flow, but these are euro cash flow. You have to convert this cash flow into US dollar cash flow. How to do it? Since the currency conversion rate 1 euro is available to 1.26 dollar. However, inflation rate is available to it. The conversion will be H1 will be 1 plus US inflation is 6.5% divided by 1 plus euro inflation is 3.75% to the power I is here to the power I into 1.26. Here I will be 0. So, you will get the conversion rate for this current, this multiply here minus 1,150 into H 0, H 0 will come, I will be 0, this will be 1.26. Similarly, S multiply here 450 into S 1, multiply here 450 into S 2, multiply here 675 into S 2, similarly 825 into S 3, and you are changing I 1, 2, 3, 4 and getting that S 1, S 2, S 3. This will give you euro US dollar cash flow. After getting the euro dollar cash flow, you go for calculation of DCF. DCF will be this DCF remains same. DCF here discount factor is, we are given to you a discount factor is 12% by MNC. By discounting this by 12%, you get the NPV. NPV here minus will be there or NPV will come over here. That will be the calculation process of this problem. Thank you.